Good afternoon, investors. Ryan Bouchey here, New Age Wealth Advisors. Hope you're doing well. Hope you're having a great uh, Thursday. It is just after market close here on Thursday, June 2nd. Wanted to drop in, give you a quick market update, some of the things and headlines we're seeing this week, impact they've had on the market, and kind of what we see as we're closing out this first week in June, as we're already into, believe it or not, June, which seems wild. It's been a fast spring and quickly approaching summer, and with the green that we're seeing today in the market, a lot of positive news in some ways, some negative news in other ways, and what does that all mean for the market here? So again, Ryan Boucher, typically joined by Todd Gordon on these Thursdays, recording just market updates. Todd, unfortunately, is out of the office this afternoon, so still wanted to come in and drop you a note and just kind of share what we're talking about and what we're seeing in the market. So, as I said, green day today, just closed, Nasdaq closed over 2.5%, S&P up over 1.5%, almost 2%. Pretty interesting moves given the headlines from yesterday, some of the headlines today. Two big areas that I really want to focus on today and kind of highlight some of the bigger market themes that we're seeing. And I know, Todd and I work so well together, especially, on these live streams when we're talking about the markets and working on the business together at New Age Wealth, because we come from a little bit different backgrounds. When it comes to the markets, I'm probably going to be a little bit more fundamental, high level. Todd, his background in trading and his experience and expertise sometimes can be a little bit more technical than I get into. So some of the themes I'll be talking about today, probably more of the fundamental nature, but really important, fit really into the overall economy and market and how I've been working with clients over past 10 plus years, and some of the conversations that we have on a week to week, day to day basis, as we're trying to make sense of what we're seeing, because it's been a really uncertain and volatile year to date. The past couple weeks, especially, last week was the first up week we had in 2 months. We had 7 straight down weeks, and I know that can be tough for investors out there. And when we have that much uncertainty, that much volatility, it can lead to some emotional decision making, and we want to try to take those emotions out of the investment process and really kind of, again, take a look and try to take the emotions out of how we're managing portfolios and making sense of kind of where this market is today. So I'm going to get into some of the big headlines. I think from this morning, keeping it on today's market, Microsoft coming out with lower guidance for the fourth quarter. That was a big one, right? You have a company, huge blue chip technology company like Microsoft coming out with lower fourth quarter guidance. They're placing a lot of the blame there towards foreign exchange rates, right? And their international business and being hurt on the bottom line due to those exchange rates. But this is a theme that I know I've been talking about with clients. I've been talking about it with Todd as we do these live streams. And I think, this is a theme that is going to be probably pretty critical in my estimation in the coming, couple weeks, couple months as we head to the second half of the year. Wall Street has their estimates for third and fourth quarter. With the recent pullback, S&P down 12, 13% year to date. The Nasdaq's off a little bit more than 20%, maybe 21, 22%. Don't have it in front of me. But with these pullbacks, they hurt. They don't feel good. But in a way, it almost feels like somewhat of a healthy pullback. I feel like stocks are kind of more in line with their historical averages from a price to earnings perspective, especially as we look forward into the future in what earnings expectations are. Again, never feels good to see the market pull back like it has, but it feels somewhat healthy in terms of getting stocks in line to what expectations are and should be moving forward. So that's been a good thing. Now, on the flip side, where does the market, in times of this uncertainty and volatility, everyone's trying to figure out, okay, where could or where will the markets bottom out? And to me, obviously, again, kind of being a more of a longer term investor with how we manage clients' money, in the wealth management space, we're not trying to time market bottoms, right? This is not what we're here to do. But I think it's important to make sense of what's going on and making sense of what we're seeing. And so if you were to kind of take a look at, okay, what's going to drive the markets either up from here or maybe drive markets another notch down, I think that notch down could come in the form of lower forward earnings guidance into the second half of the year. Because, like I said, earnings and stock valuations have come more in line with probably more historical norms with this recent pullback. If we start to see Wall Street and these corporations kind of ease off of what their third and fourth quarter earnings estimates are going to be and what those guidance look like, that could be a driver of maybe another shift down in the markets. Doesn't mean it has to, but definitely could be. And that's why, I personally found today so interesting, right, with Microsoft's guidance, because let's face it, if they're issuing guidance on uh, exchange rates and the impact that's going to be or that's going to have, when you look at the S&P 500, the large cap companies in this country, they make up, almost 50% of their revenue comes from overseas dealings. I mean, that could have a big ripple effect through the rest of the economy and the rest of the companies that are going to be, reporting and having more guidance as we move forward. And so I think that was a huge headline. And to see the markets react as they have and be so positive today was definitely interesting to me. I would have thought that would have been a, pretty big signal of a potential down day or even potential down few days in terms of what that news meant to the market. But markets did really well, and so again, I don't know if then you kind of take a step back and say, are we at that point where bad news could be good news for the markets? It's never, you can't do it in real time. It's so hard to predict these things, but we've talked about it again. Markets are going to bottom when news is as bad as it can be, right? You don't wait till you start getting some positive economic feedback or positive economic data, good news in the economy or the markets for the market to start taking off. It doesn't happen that way, right? The markets are going to start recovering when all things seem, relatively bleak and dire. That's just how markets move, right? They're always going to be forward looking. If you look at the normal market cycles of economic cycles versus market cycles, mainly in line, mainly correlated, but the market always moves a little bit ahead of what the economy is doing. And so are we getting to that point, right? Are we getting to the point where bad news is good news? Because with what the Fed is doing and what their expectations are, we know what they're going to do in the short term. There doesn't seem to be any question that over the next couple meetings, they're planning on raising rates 50 bips for each of their meetings. We know, we pretty much know that's going to happen. Lael Brainerd came out today and announced, no reason to back off what the Fed's intention is. Jay Powell was out a couple of days ago talking about it. Their goal is to slow this economy down. And if we start seeing signs of that, maybe in fact that could be a positive. That could be a good thing, right? Markets have pulled back. Markets are more in line with what expectations could be, from a economic fundamental standpoint. I still truly believe that if we are heading towards a recession, and we may be, we've had one negative quarter, which again kind of was more in terms of the underlying data. It didn't have to do with consumers; it had more to do with import exports. And that has a lot to do kind of with again the coming out of COVID, the geopolitical issues we're seeing overseas. Not so much of a slowdown by the consumer, right? The consumer is still very strong, still doing very well, tight labor market, high wages, good balance sheet still. Those are all positives. But if we were to head towards a recession, I still truly believe that it's going to be much different than what we saw in the '08, '09 financial crisis, right? Driven by over-leveraged consumers, which we don't see today, driven by banks that were not well capitalized, which we aren't seeing today, exotic financial products that ended up blowing up at the time, which we aren't seeing today. It was different time back then and different drivers. Maybe some similarities people point out with the housing market. Again, different set of circumstances, yes, in terms of the rise in housing and affordability, and I can get into that a little bit later. Some similarities, but a much, much different market environment and drivers towards that, right? Borrowers today are in much better position, higher credit, well capitalized, and just in a better, putting more down. It's a different environment. In the driver of the high prices, again, probably more from a supply and demand set of circumstances versus sort of the speculative nature that we saw back then. So I think it's different from the great financial crisis in that regard. You go to the dot-com bubble, right? Let's talk about the last two major recessions, bear markets we've seen. Again, feels a little bit different, right? Similarities in terms of tech space being, overvalued and a little bit ahead of their skis. But again, most of the companies that we have today, especially the big ones, are solid companies, continue to drive, profitability, good earnings, good revenue growth. It's a different environment than when we saw it back then. Doesn't mean we can't have a pullback. Doesn't mean we're not going to have a slowdown. We're already seeing some, you know, slowdown in hiring, some layoffs in some of these technology companies. Is that going to continue? Is that going to have a little bit more of a ripple effect? Certainly could. So doesn't mean we're not going to, head towards a potential recession, but I do think it's going to be different than what we saw the last, not as severe, and potentially quicker to recover. So if we are heading that way, right? What does it mean for the markets and what the Fed's going to do? Maybe as the year goes on, maybe it is a little bit of a slowdown in terms of what the rate hike policy is going to be. Maybe they don't need to. Or we're already seeing stabilization on the 10-year, right? We spiked over 3% briefly a couple weeks ago. We've stabilized under 3%. That's been a positive, as the bond market is compared, I guess, to the equity markets right now. And so overall, right, we're kind of seeing the coming together of a couple of different um, areas of the economy, and I think it's really important to keep an eye on that. So forward earnings guidance for the back half of this year, it's going to be really important to keep an eye on. We're going to continue to see that, see what kind of impact. And like I said, I think today's news was certainly interesting because not what I would have expected, but maybe it's a bigger sign of what's to come. The other major headline I think from this week that had a pretty big impact on the markets was Jaime Dimon yesterday, right? He came out and essentially forewarned of uh, coming economic hurricane, telling you to prepare to brace yourselves. Really interesting sentiment. I mean, he's typically not coming out and being that negative or bearish on the economy. And for him to say that, coming on the heels of a week or so ago where he made comments that the economy was in pretty good shape, right? He wasn't saying that there was no chance of a recession, but said that, hey, there's clear skies ahead. Again, the consumer balance sheet is solid, not as much to worry about. And then a week later, come out with a really like doom and gloom kind of sentiment. Really, really interesting to see. And it felt like yesterday morning that almost kind of took the markets by storm, uh, reversing any of the early gains that we had. And so definitely felt that negative sentiment. Almost felt that he was going to bring the markets down on his own. And you had him, you had other big Wall Street banks, Brian Moynihan from Bank of America last week, and again had all similar sentiments in terms of saying that, hey, consumers are strong. We're seeing higher saving balances this year than we've seen even pre-COVID. Things are fairly good for the consumer. And as we always, I share a lot that U.S. consumer makes up more than 2/3 of our U.S. GDP. There's such a driver of what our economy is doing that it's important to hear that positive sentiment from some of these big banks, and that's why it was so surprising yesterday, Jamie coming out and being so negative. And to follow up on that, even Brian Moynihan from Bank of America, I think, followed it up to say and refute what Jamie was saying, and to say, no, we are in solid positioning. The consumer's still strong, still see a lot of positives here, and that should be a continued strength as this economic cycle continues to carry on and move forward and push forward. So good news there. We've seen from the retail perspective maybe a shift in consumer spending habits, right? We are seeing that slow down. We talked about it earlier with Amazon, with Target. Their numbers for the first quarter not as strong, but we're seeing kind of all the negative maybe we're seeing on retail. We're seeing just as much strength on the other side in terms of services, travel, leisure. We're seeing maybe a shift of, again, consumer behavior, consumer spending, where they're putting their money to work. And I've said this, and I'm going to continue to say it. I think over the next year or two, it is going to be really, really hard to make sense of, month over month, year over year economic data until things shake out from the disruption that COVID caused and COVID created for us. Because again, we've had so many kind of ups and downs, lulls or peaks in kind of the spending in this country, reopenings and openings based on shutdowns and lockdowns. It's going to take another year or two for all this to shake out. So to just kind of make big proclamations or to make decisions based on a year over year trend in data, I think we have to kind of take a step back and really see what does this mean against a backdrop of COVID and the environment that we've seen over the last 2 years. Because again, coming out of a global pandemic, there's going to be some, you know, bumps and changes in spending behavior. I mean, we've seen it from, you know, housing and working from home and all these other areas of impact. This is going to take some time for it to normalize and to really make sense of some of this data overall. But as I take a step back this week, probably the two biggest headlines and areas that I've been focused on is that, what Jaime Dimon came out yesterday and said, as well as today's news on Microsoft. So really interesting stuff. Talked a little bit about the Fed, Lael Brainard's comments. We had the Beige Book come out yesterday, covering some of the economic data from about mid-April to mid-May. We're seeing in that report 4 out of 12 areas in the country are showing some weakness in spending. Obviously want to be aware of that. Continue to kind of see how that plays out as we move forward. Definitely interesting to follow that and kind of see what pockets of the country are doing well and which other areas may be kind of slowing down a little bit. And again, as I talked about earlier, the market, we have economic cycles. We could just be heading to that phase of a peak in a normalized economic cycle. And again, having a pullback in the markets, that's going to happen. We're going to see that. Doesn't mean it's got to be the same extent that we saw in the last two major ones. But it's not uncommon to see markets in economies move in cycles, and we have to be aware of that. We have to be ready for that. I mean, markets do peak when things look the best and start to show signs of weakness. Again, a pretty normalized market cycle. The last piece of data and newsworthy, I think, for the week, and it kind of relates to my personal situation, right? I've talked about looking for a home here in the Boston market. Knock on wood, so far we are under contract over the last couple of weeks, moving forward with the home in Boston suburbs. And in many ways, it's a little scary, right? We're seeing maybe a little bit of a slowdown on a national scale in terms of housing data. We're seeing, spike in terms of housing affordability, both with market prices going up and interest rates going up. Not the best environment. And if you're in a similar boat or similar situation, I always say to clients and have these conversations a lot, right? Your primary home, primary residence should not be viewed on as a investment asset, right? In some cases, people that have gotten great returns from them, they've been able to build wealth through a primary residence, but in the grand scheme of things, should not be viewed as an investable asset. For us, again, as difficult of a time it was to find a home and to settle down, the most important thing to me and my family, three young kids who all, by the way, are probably here. You may even hear them. Household has COVID this week, so we're, they've all held up pretty well, but we are getting a little stir crazy as it hit our house over the Memorial Day weekend. So we're getting towards the end of our quarantine phase. But, most important thing for us is getting the family a home, giving them stability, and if you're making the right decisions, I've written about it in terms of making the choice of where you're going to buy, doing it for making sure it's going to be a longer term purchase. Hopefully that gives you peace of mind as you kind of see some of this data come out in terms of potential slowdown. I saw prices are coming down at the highest rate that we've seen in quite some time. Now, that just may mean people were putting their houses on the market for much higher than they should, and they needed to pull back. I do continue to think that, especially in some pockets of this country, it's going to be more of a regional in terms of what the housing market's doing, whether you see a sharp pullback or kind of a stabilizing, plateauing. I think in some of the hot markets, you're probably going to see more of a plateau because, as I'm seeing here in Boston, ton of demand, low inventory, and don't see that changing really anytime soon. But I do think it's going to be more of a regional, city by city, regional kind of issue, and it's going to play out differently for different markets. But like I said, if you're in that situation where you are looking for a place to buy, I'll even reshare kind of the blog I wrote about that and the things to consider for that longer term purchase and being really sure when you're making that choice. And again, you got to kind of look at it, unfortunately, not as so much as an investable asset, but more so of a place of residence and what's important to you and to your family. And that's got to be the main driver here. So those are the big hitters that I wanted to get into today. We're going to get tomorrow morning. We're going to see the latest jobs report for May. That's going to be interesting. ADP report came out today. A little bit of a slowdown. Again, maybe that's leading to positive market sentiment, right? Some of the bad news in the economy, if we continue to see that slow down, means what the Fed's doing, even though they're not going to come out and say, hey, our goal is to necessarily slow down. They're going to slow down inflation. They're not going to come out and say, hey, we want to, put a damper on the economy. But if we're kind of starting to see some of those trends, but there's still good underlying strength, that may be the best kind of news for the market. Having a soft landing is going to be difficult. I don't think that's going to happen. There's too much at play, but we could still, get through this in a way that's doesn't have to be much worse. And like I said, I think where the markets are at today, based on current valuations and forward-looking valuations, a reset that probably needed to happen, and so far, I think, probably somewhat expected to a certain degree. So with that, appreciate you joining. Hope you have all a great first weekend of June. Enjoy kind of this incoming summer season, and we'll see you next week. Take care.